I don't even think that it's the material. If you saw that material and you used it every day, I don't think you'd consider it hard. It's material that when you think of preparing individual taxes, it's just not something that you've seen on an individual tax return. And most of you have done a tax return. You've done a tax return for VITA. You didn't see any of that stuff in chapters 10, 11, even a little bit of 12. So it's just foreign. So you look at it and you're like, I don't get it. But if you saw it all the time, it would not be difficult. Whereas now, 13 obviously is compensation, so that all makes sense, even if it's a few things you haven't seen. Today we're going to talk about home ownership and renting a home. And there's going to be a few things on renting a home that you have not seen and how we calculate rental and how you split out expenses. You might have done someone renting a home, but you probably have relied on your software breaking out rental expenses. And depending on the type of software you use, if you're using TurboTax is not going to know how much it will. If you do it right, you can put in your expenses for the entire home, and then it will break out based on renting. But you better make sure you really fill it out right, and I'll show you why tonight, because there's two different ways that your home can classify. If you're a non-resident or if you're a resident. And then if you're a resident of the home, if it's your residence, then it can go in two different places on your tax return. So we want to make sure you're filling it out right. So we will go through this. Tonight is the last night that we're covering a chapter. Next, is it Wednesday or Friday that your tax project's due?
What's the number? Is Friday?
I think it's Friday too. Your tax project's due on Friday, and then your exam is due the following week. So you kind of have a couple spaces of things in there. That's a great question. Let's look at this syllabus. I think it is. And that is Friday.
Yeah.
Yeah, so we have next week, we don't actually have anything new at class. So that's what I was saying. I'm here if you guys have any questions, but your project isn't due until the 9th. And then your exam, and of course I just didn't pull up the syllabus when I did that. Your exam is due. I'll have to pull it up when we're done with the PowerPoint on the exam dates, and we'll pull those up before you leave tonight and kind of talk about it. So let's get going with this, and then we can move on and talk about the exam and the project and see if you guys have any questions. I think you probably saw my email. I think I sent it out Sunday. That kind of said, I think only about half of you guys, when you look at you, plus the online students had downloaded the project. So I'm hoping when I go out towards the end of this week, that more of you had downloaded the project and started looking at it. Okay, so then you did it since I asked, so that's good. Again, the problem is it's not that I'm worried that you won't have time to do it. I don't know how long it's going to take you to do it. I know that I'm expecting it to be very similar to my other project, but all of you work at different speeds, and so I want you to take a look at it so you have an idea of what you think it's going to take, and you don't wait until Thursday night. Look at it and say, oh my God, this is going to take me 10 hours. Well, yeah, I think it could take many of you 8 to 12 hours.
I spend 6 hours, I get 82.
Okay, so he spent 6 hours and he's got an 82. All right, so if you want an A, it wouldn't surprise me that you're going to spend 10 hours, because that 82, my guess is that next 10%.
It's impossible.
No, it's not impossible. That next 10% is going to be that difficult part of what am I not doing right. So getting the things typed in, getting the numbers in the right places, those are the basics that I think a lot of you getting that 70 and 80%, you're going to get done in 4 to 6 hours. It's the next 4 to 6 hours that some of you are going to need. Yes, is someone going to get it done in 4 hours? Yes, someone probably will. But I think the average student is going to take somewhere between 8 and 12 hours to get it done. That's my guess. And that's what I'm expecting. Like I said, Marcus's daughter used this at Kansas. She was very particular in that she wanted to get it right. She was going nonstop trying to get she had quarter points being taken off for little nitpicky things, and she wanted to know why. And that's how I got looking at the project, because she's like, what is wrong with this? She could not figure out some of the numbers. And some of those things.
There are little tweaks, because I've got a half a point off for the state.
Well, what did you do with the state?
And
Nothing?
For Missouri.
Okay.
What else can you do with it?
Okay, I'll go in and look. See, that's the thing, when you see something like that, tell me, because when you upload it, I can go in and see why it's taking a half a point off. So I can go in and look, if you already graded your own, see, until you tell me you graded, I don't know that you
Yeah,
graded it.
I've-
So I can go in and look and see why is it taking off a half a point. So I can go look. My guess is it dumb? Is it expecting capital lowercase? You know, was it something like that? Obviously, when I go back in, if that's the case, I'm not gonna take a half a point off for that. Okay, so there's gonna be some things I'm going to have to go in. So if you get a 92, I'm gonna go in and look and see why you got a 92. Now, if someone got a 62, I am not gonna go in and see why you got a 62. I will go in for some of those tweaks, the Missouri, and some of those things that I know some of the top grades still lost half a points. I will look for those on everybody's project. But if you get a 62, I'm not gonna go in and try to look at every reason why you got a 62. I'm using an auto-graded project, so I don't spend an hour grading everybody's project. So, but I will give everyone the same benefit. If I'm gonna go in and see that, you know, someone that got a 95, and there's a half a point here, 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 and here, I'm gonna go see why we're getting those half a points. And if I'm gonna do that for this person, I'm gonna do it for everybody. So I will go in no matter what your score is, and if it's MO with a lowercase o, then I will go add that half a point back to everybody's score. So if you got a 68, you got a 68 and a half. I will add that back in no matter who.
We had, with the state, we need to like Missouri.
I don't know. That might be it.
doesn't give you room to
Right.
write
Yeah, but
Missouri.
I write it and said, okay.
Oh, so it wants you to type Missouri and then it changes it to MO. All right, so and I'm recording this, so if they listen to the lecture, they're going to hear, if you type Missouri, it will change it to MO. That's moronic, but that's what it's, so, that's some,
moronic.
so I actually will, when I send out the thing, I'll type that up. Huh?
I just changed it.
And it worked?
Yeah, because no, it's just showing me like because it's small space,
Okay.
so it's showing me three. I mean, just MISS, not.
Oh, it didn't change the MO, but it says it's okay. But it, did it take off any points? Oh, you haven't auto-graded it, so, but he's saying when you load it up, it doesn't take off any points. So it might not change it to MO, it truncates it, but you're saying it doesn't take off points, so. So, yes, if you auto-grade it and you move it up and you think it's something dumb, or you can't figure it out, I'll go in and look at it. Now, I know there are some individuals, and I can't say they're in this class, but sometimes it happens, where you have a question, you have a question, you have a question, you have a question, and it's not this class, but I have somebody that will send me 6 questions before I can answer 1. So, no, I'm not gonna go into your tax project 6 times in one night and check on something. But if you go in there and you're like, hey, I uploaded it, and these 4 things don't make any sense to me, I will go in and check them out. I won't give you the answers, but I can let you know, no, you're just not doing it right, or, yeah, it's doing something funny. So I definitely will check that out. So definitely when you're working on it, once you get to a point, I would not just upload it. I would make sure you get a substantial portion done like you did, and you uploaded it, and you know you got an 80%, so you know that you're good. But obviously if you want to do better, you can then go back and figure out what you got wrong. The nice thing about getting it graded is you know what you need to fix, instead of sitting there trying to figure out what you need to fix. So, okay, so this week we're talking about our home, all right, our wonderful home. So the tax consequences of a home and what is going to happen in it. And there's a couple different things we're going to talk about. We're going to talk about the tax consequences and the disadvantages of having a home. We're also going to talk about selling a home, and then we're going to talk about renting a home. And at the very end, we're going to talk about using the home as a business deduction if you're working from home. So the first thing I talk about is what is a home, what's considered a home, and surprisingly, it's not just your house or condominium. Your home can be a boat or any similar property in which you are living. So yes, if you're living out of a motor home, your home could technically be a motor home, just like it could be a boat. So a home is any similar property, that dwelling that you're living out of. A dwelling unit can be used for personal, a mix of personal renting, or just renting. We're going to talk about renting and how it's different if it's just for renting use. Now, depending on how you're using it, residence or non-residence, depends on, for tax purposes, depends on how you use it. So these are some of the important numbers that we're going to use as we go through the renting process. So personal days is the greater of 14 days or 10% of the number of days rented during the year. All right. So it's a residence if your personal use is 14 days or more, or 10% of the number of days rented. Otherwise, it's a non-residence. So you have to live in it for 14 days for it to be considered a residence. If you don't, it's a non-residence. So what are personal days? Okay. Hopefully, it's somewhat self-explanatory, but the days that we stay in it, a relative stays in it. The third one is a little bit different. A non-owner stays in the home under a homeowner's exchange. So it can be a homeowner's exchange swap. So if you're staying in someone else's home and they're staying in yours, that is considered your home. You're not renting, you're exchanging homes. So that is considered a home. And then days you rent out for property less than fair market value. If you're renting the less than fair market value, it's considered a residence. Rental days include when you rent it for more than fair market value or at fair market value, and days you spend maintaining or repairing. So when you don't have your home rented, it's sitting there empty, but you're repairing it or maintaining it for rental use, that's considered a rented day. All right, days that it's available for rent, but no one's living there and you're not maintaining it, you're not repairing it, that is just a non-rented or non-personal day. It's just a day. All right, so residence is a principal residence. It's subject to determination and it could change every year. So if you have multiple residences, which one's your principal one can change from year to year. So for tax purposes, a dwelling may be a personal residence, principal residence, a residence, or a non-residence. So if you own 3 different, 4 different, 5 different properties, one is your principal residence. You cannot have more than one principal residence. You can then have a residence that's not your principal residence, and then you could have multiple non-residences if you have rental property. So if you're lucky enough to live here and have a lake house and have a house in Montana, right, or a ski house, your house here might be your principal residence, your house at the lake and your house in Montana would be your residences. Now, if you had a lake house, your house here, and you had a house in Montana, but the house in Montana was strictly rental property, you might stay at it 1 week out of the year, but the rest of the time it's rental, then that would be a non-residence. Your lake house would be a residence, and this would be your principal residence. So here's a little summary. This is in your book, Exhibit 4-1. It kind of goes through how things show up when you're looking at them from a tax standpoint and where they go on the financial statements. So notice residence and principal residences, those are deductions from AGI. These are going to be itemized deductions. So they're going to go on your Schedule A. So home mortgage interest, home equity interest, mortgage insurance, which we're going to talk about, and property taxes. All 4 of those things are both your residence and your principal residence you can deduct. So your lake house and your home here in St. Louis, you'd be able to deduct all 4 of those things. Now, deductions associated with renting is for AGI because that's going to go on your Schedule E, Schedule E, which is going on the front page of your 1040. And that's going to be on line, right here. That's the second page. It's going to go on line 17 with the Schedule E. All right. Now, notice if we rent our principal residence for any reason, and we'll talk about that, or our other residence, it will also go on Schedule E. It will just be a proportion of it. Now, exclusion of a gain on the sale. Now, notice these 2 have asterisks. If we have an exclusion of a gain on a sale on our principal residence, all right, we can exclude it, assuming that we meet all the qualifications to exclude it. If we want to exclude the gain from a principal residence, from a residence or from a non-residence, it had to have been a principal residence. Otherwise, you can't exclude it. So a non-residence, if we never lived there as a principal residence, then we cannot exclude the gain. If we never lived in this residence, we never lived at our lake house as a principal residence, then we cannot exclude that gain. And we're going to talk about what those exclusions are, what the qualifications to exclude are, but one of them is the fact that you had to have lived in it 2 out of the last 5 years. So that's what it's saying right here, okay? If you haven't lived in either one of those, the non-residence or the just plain residence, it's not a principal, 2 of the last 5 years, then you cannot exclude the gain. And the last one, forgiveness of debt, which is a huge one, it is only on your principal residence. And basically what that means is your home was foreclosed on. Now, a couple of these have not been extended into 2016. I'll talk about them when we get to them. But as of right now, they have not been extended into 2016. That is very common, that tax credits and tax, that's not a credit, it's tax provisions are not extended until sometime in November or December. When you have a new president, a lot of times they are not extended until the very, very end of the year. I don't know what's going to happen this year. I don't know if there'll be any big changes, if they'll just let them roll. I can't remember 8 years ago when Obama came in, if it was that year that things changed, like right after he was elected but he wasn't in office, or if it was actually the next year. So I don't know how that's going to happen. But it is very common that things do not change, because when you have an election in November, especially when they're lower level, when you're looking at senators and congressmen, they go into office, a lot of things change because they're the ones that are actually passing it. I know it sounds funny. It's not always the president, all right? He might be the top guy, but it's really all the people that are replacing underneath him, because they're the ones that are saying they're voting yes or they're voting no. He can veto a lot of stuff, but if they voted no before it even gets to him, it doesn't matter. So what are some of the non-tax consequences of owning a home? All right, so a consequence of owning a home, it's a very large investment. All right, people found that out between 2008 and about 2013. When the market went the wrong way and jobs went the wrong way, people had a house they couldn't afford. It's a very large investment. All right, it's a potential for a big return or a very big loss. All right, so my mother-in-law is being able to rent a condo because the individual that she's renting it from is upside down. Meaning she bought the condo for, I believe, like 80 or 85, and they're selling for 50. So she can't sell it. But she's moving out, and so her only option is to rent it. So big return or big loss. Risk on default of the home loan. Again, 2008 to 2012, a lot of defaults. Time and cost of maintenance. That one is underestimated a lot of times. And limited mobility. If you decide you want to pack up and move, you can't just pack up and move. If you rent, the worst thing you got to do is cancel your lease, right? A couple months lease, a couple months rent that you got to pay or forfeit, and you're out. Can't do that if you own a home. So a couple things like that. Consequences on the tax side, some of them are positive. You get to deduct your interest. That's a good thing. You get to deduct your property or your real estate taxes. That's a good thing. Your gain can be deductible or excludable. Sorry, your gain can be excludable, so you can sell your house at a gain and not pay tax on it. And your rental and business use can be deductible. So you can possibly deduct some of your rental expenses, and you can possibly deduct some of your business expenses. So there's a lot of positive tax consequences that usually offset the non-tax consequences. So when we're looking at the sale of the residence, typically a gain or loss is recognized. It's a capital gain or loss. Okay, we've talked about capital gains or losses. So on that, when we're looking at our 1040, typical capital gain or loss is going to show up on line 13. Because a house is a personal asset, you do not get to deduct a loss. If you sell your house at a loss, you just have a wonderful loss. And that's a bummer, but that's the way it is. Now, if you sell it at a gain, you have to include the gain. You can't deduct the loss, but you have to include the gain, unless you meet a few of these exclusions. Now, I sold my condo at a gain in 2000, was it 2000? No, it was not 2000. In 95 or 94, I can't remember. And this was not in place. So I had to pay capital gains because I sold my condo at a gain. And I swear this came in like the next year. I mean, it was like, are you kidding me? But I sold it, and I had 2 years to buy another one. There was a 2-year time frame. But I took 2 years, but it was just, I was not ready to buy something else. And I had a gain. It wasn't a gigantic gain. So I just paid the 25% capital gains and was done with it. And literally that came out like the next year. So basically what this says is you get an exclusion, 500,000 married, 250,000 for individuals. The gain is the accession of the gain. So if I sold my house for more than a $250,000 gain as a single person, then I would have to pay a capital gains tax on whatever goes above that $250,000. Now you have to meet what's called ownership and use test. First of all, you have to, the taxpayer, so the taxpayer has to live in the house, let's do the ownership, has to own the house for 2 out of the last 5 years. All right, so we have to own the house for 2 of the last 5 years, ending at the time that we're trying to sell the house. Now, if you're married, either one of us can satisfy that date. So if Jim and I got married, my husband and I, but I owned the house before we got married, then that qualifies as ownership. Jim does not have to own it for 2 of the last 5 years as long as I owned it for 2 of the last 5 years. All right, this is meant to prevent people from flipping houses. So if you go in, you cannot go in, buy a house for a year, 6 months, turn around, sell it for a gigantic gain and not pay tax on it. You have to own it for 2 of the last 5 years. The use test says that 2 of you, both taxpayers, have to live in it for 2 out of the last 5 years. So if married, you both have to satisfy it. The requirement is meant to ensure that you are selling homes in which you are actually residents of, that you are not selling non-residents and taking an exclusion for property that you rent, or you're not taking this gain for a residence in which you are not actually living in. So here's an example. Tyler and Jasmine are married. Jasmine moved into Tyler's home located in Colorado. Tyler purchased the house 2 years before they were married. After the marriage, and they lived in the home together as a principal residence for 3 years before selling the home and moving to Chicago. Tyler was the sole owner of the home for the entire 5 years. Would the gain of the home qualify for the $500,000 exclusion, even though Jasmine never owned the home? Yes, because he was the owner, and he qualifies for the ownership, and they both lived in it for 2 out of the last 5 years. Because even though he owns it, and that qualifies the ownership, they do both have to live in it to qualify for the use. Now there's a few exceptions to the general exclusion rule. There's something called the non-qualified use limitation. All right, and basically it applies only if the taxpayer has non-qualified use after 2009. It includes times in which it was not the principal residence. So non-qualified use basically is saying that you lived in this house as a principal residence and then you moved out of the house, lived in a different house, maybe down at the lake, and then you moved back into that house. So there was some time in which you were not in the house, so that's non-qualified time. So the non-qualified time, that period, does not include any of the 5-year period during that time. So it's taken into account. The amount of gain realized is eligible for exclusion based on the ratio. So basically you just have to go in and figure out how much were you not in the house, how much were you in the house, and based on that, do you qualify for the exclusion. The second one, hardship circumstances. If you are required to sell your house prior to the 2 out of 5 years for ownership or use, you can qualify to use the $500,000 or $250,000 based on a proportion, a ratio, if you're qualifying under hardship. So basically, you have to sell. And the ratio is basically going to be the $250,000 to $500,000 times the number of months that you did need it over 24. So you can get a portion of it. So for example, this kind of shows you the full exclusions right there. You take the number of qualifying months, and then the number of total months that you should have lived in there, the 24 months, and you could actually use the number of days also. If you feel like the number of days gives you a better amount versus months, then you can also use that. So take a look at this one. You might need to jot this one down to come up with an answer. They're having to move, but they're not a solid time. So do we know how much of the $150,000 gain the Jeffersons would, or recognize at what amount would be taxed? How much?
81, 250.
No, it's going to be less than 250 because they did not stay in the house for the entire time frame.
81,000.
Oh, 81,250? No, it's going to be more. It is going to be more than that. We are going to take the 500,000. How many months did they actually live in the house? No. Count again. Close. Not 6. Not 8. Go between the two.
7 months.
7 months. They lived in it 7 months. All right, so July 1st through the end of February. So July through December is 6, and then you got all of January. So you take the 500,000 times 7 over 24. And that's going to give you, they can't exclude 500,000, they can exclude 145,000. So they gained 150, so they're going to have to declare 4167 as a gain. So that's how much of a gain. They can exclude 145, they have to declare 4167. So that's how much they'd put as capital gains. And I will tell you that wonderful capital gains form is fun to find when you try to fill it, because there's actually a home for the sale of a form for the sale of your home. Not easy to find in tax-wise, but there is a form for the sale of your home. So now what about forgiveness of debt? This is one that I was telling you about. So it applied through December 31st, 2014. It had not been extended when they printed this book, because they printed this book last year. It was actually extended. It has not been extended into 2016. So it can be up to $2 million of forgiveness of debt. So that means up to some very big houses could be forgiven. But we don't know if it's going to go into for this tax year or not. So right now, anyone that did foreclose on their house technically will have to pay taxes. Now, do you guys understand how that works? Cancellation of debt and all that? No? Okay, so how that works, let me find my pen marker. So how that works is, let's say you have a $500,000 mortgage, all right? If you have a $500,000 mortgage, and that's how much you owe the bank, but you can't make your payments. And so you haven't made the payments and you haven't made the payments, and the bank comes to you and they tell you that they are going to relieve you of your debt, okay, forgive you of your debt. There's two ways that they do that. Sometimes they'll just say we're going to forgive you of your debt, but we're going to take your house. Okay, usually that's what happens when it comes to a house. The problem arises that if you have a $500,000 mortgage, what can they sell your house for? If they can sell your house for $500,000, great. You don't owe them anything. That's not what's been happening over the past few years. What's happening is they can sell your house for $300,000. So there is a little bit of a problem. They sell your house for $300,000, you owe them $500,000. That means there's a difference of $200,000. So forgiveness of debt basically says the bank is willing to say, based on this, well, not based on that, but the bank is going to forgive you. They're not going to make you pay that back.
For 200?
They're not going to make you pay the $200,000 back. The main reason is they know they're never going to get it. So they forgive you of that debt. It doesn't happen a lot in mortgages, but it does happen, okay? If they forgive you of that, technically, that is income. Because you no longer have to pay them $200,000. That is the bank giving you $200,000. If they give you $200,000, that's income, and therefore you have to pay tax.
Capital gain or
No, just income.
ordinary?
Just ordinary income. So you would pay tax on this. This, what we're talking about here, the exclusion of debt, forgiveness of debt on a mortgage, would mean during these last couple years, because there were so many foreclosures, that if you were forgiven, you did not have to pay the tax on that. Now, these were not everyday people, all right? A person with a couple jobs that bought a house too expensive for them were not going to be forgiven of their debt. It's meant for more of a hardship, hard luck, lost their job, that type of thing, that were forgiven of their debt. Now, some of the more common are cancellation of debt. Cancellation of debt, very rare student loans, though we did have a couple last year. It's more like credit cards. So credit cards, let's say you owe $5,000 to your credit card company. They know you're not going to pay them back. So it's a cancellation of debt is you're not going to pay them back. So they write it off. That is income. If you no longer have to pay Visa $5,000 and Visa gave you $5,000, you then have to pay tax on that $5,000. Okay?
This doesn't work with
This is only for mortgages, all right? And so my dad had this. There was a lawsuit. We were talking about timeshares earlier with Montana. They had another one that was out on the East Coast somewhere, but it's through Marriott. And they bought it years and years and years ago, but the property never developed like it was supposed to, like they got in at the beginning, and it never developed, and it was on the coast. And so a group of them, whoever those them is, but a group of people that also got in on the same timeshare, they went in and they sued the company that did this, and they won. And they, whatever the payments they had been making over the prior years, they took that and they applied it towards whatever they were supposed to pay, and then they were let out of their condo timeshare agreement. So my dad then calls me and he says, I don't know what this is. And it was a cancellation of debt. Because they let him out of the agreement, the way it was viewed is it was a cancellation of debt that he owed. Now, I actually thought that was kind of pushing the lines, because to me it was technically a lawsuit in which they won and they didn't have to pay because Marriott didn't live up to their end. Obviously, that wasn't necessarily the case because they were able to issue cancellation of debt. So he had to declare that income. It went on line 21 as income because he no longer had to pay Marriott the monthly fees for the next whatever years. But what he did have to offset it is he had lawyer fees. So basically the amount of money they paid the lawyer basically offset what he was going to pay. I mean, it was ridiculous. And so he ended up not having to pay much tax from that standpoint. But that's what cancellation of debt is. And we get people in here for VITA that will get very upset that they have to pay tax on it. And they'll say, well, then it doesn't even matter that they canceled my debt. And you got to look at them sometimes. You got to say, okay, you owed your credit card company $10,000. And now you're going to have to pay them $2,000 in tax. Which one's better? Don't get me wrong. It completely sucks that now you have to pay $2,000 right now, or you're going to pay a penalty. But it's $2,000 or it was $10,000 at what, probably 17 or 18% interest.
Yeah.
And the government doesn't charge that high of interest if you can't pay it. So which one's better? $2,000 or $3,000 if it would have been $3,000, you know, whatever your tax rate is. So, but unfortunately, when you're not expecting to have to pay $2,000 or $3,000 in taxes, that's the initial instinct that you get. Okay, so now continuing with our interest and our tax and our house. So when we're looking at our home, we now move on to our interest expense deduction. And so we are allowed to deduct what's called qualified resident interest. And qualified resident interest is when we own the home and we are living in the home, and we can deduct itemized deduction under, it goes on line 10, and that's home mortgage interest. Now, we don't have to just live in a home. So we can also deduct the interest from the lake house. So you can deduct interest. If you notice, qualified resident interest includes interest paid on acquisition indebtedness, home equity indebtedness, and any by a qualified residence. It's not principal residence, it's qualified residence. It's usually home 1 and home 2. Not home 3, 4, 5, 6. Home 1 and home 2. All right. So that will go on line 10. Line 10 of your Schedule A. Now there are some limits. So your acquisition indebtedness is limited to $1 million. All right. So you cannot have more than $1 million of interest expense. Now, I don't know if anybody owns a home, but that's a lot of interest expense. All right. I don't come even close to that with my interest expense. And then your home equity cannot exceed $100,000. So that's it's your secondary loan that you can take out. You don't have to have one, but you can take one out. That cannot exceed $100,000. And then if they exceed that, there's two different methods in which you can use to try to figure out how much you can actually take. So let's look at, this is an example of the Jeffersons. I keep using the Jeffersons. So first just look at what we have. So our original loan is $290,000. Our second loan is $70,000. Our home equity loan number 2, it's $50,000. So we didn't actually have even 2 homes. We just have one. And so the first mortgage is only $290,000. So like I said, it's not $1 million loan. It's $290,000. And think about it. When you're thinking about $1 million loan, think about the house. That's what I was saying. I mean, I live in a nice house, and my loan's not anything close to $1 million. When you have a loan of $1 million, you have a really nice house because you're putting something down on that house too. You're not buying $1 million house with no money down. So $290,000 plus the 70 plus the 50, you have $410,000 in debt on your houses. You got interest rates, so it comes up with, this is your total amount of interest paid. Now, our problem arises when it says how much of that interest can we deduct. So based on what I just showed you on the prior tab, or prior slide, acquisition indebtedness cannot be more than $1 million, and home equity cannot be more than $100,000. So our acquisition indebtedness is not more than $1 million. We only have debt of $290,000. But our home equity equals $120,000. So what we have to do is we know we can only use $100,000 of that. So one way of doing it, they're going to use the average interest rate option. So what they're going to do is instead of sitting there and trying to figure out which one at which rate, or are we going to use $70,000 at 7% and then only use 30,000 at 9%, what they're gonna do is they're gonna take the total, 410,000, and they're gonna take the 2680, and they're gonna make it proportional. So 2680 times 390, which is the 20,000 that they have to take off, divided by 410. And that gives us 25,493. All right, so we know we're $20,000 too high. So that's where we're coming up with the 390,000. All right, that's how they're going in using that option. And usually that's a pretty easy way of doing it. How much can you deduct? 390,000. How much do you have? 410. Take that times your total amount of interest. So then that number would be what you would then put on line 10. Home mortgage interest reported to you. Now, that's not what's going to show up necessarily. That's what, because think about it. You might get a mortgage statement for the first one for $17,400 from U.S. Bank. You then could get another mortgage statement, or it could be in the same one from U.S. Bank for the 70 that would show the $4,900. And then you could get another mortgage statement from Bank of America or from a mortgage company I can't think of a name of for the $50,000. So they don't know that you've exceeded the $100,000 of home equity. So if you're doing it by hand, you've got to do that yourself. If you're using a tax program, it should do that for you. But the way you would know is if you're over $100,000 of home equity, you know that you should not be deducting $26,800. It should be less than that. All right, and so another thing we have, and again, this was something that started in 2007. All right, we had PMI, private mortgage insurance, and there it says mortgage insurance premiums, but it's private mortgage insurance. It's basically what it is. We had PMI, I think, until about 2004, and it was not tax deductible at any of that point. But mortgage insurance premiums paid during the year are deductible. They actually go on line 13. They are one of the most commonly missed things in VITA. And I'm willing to bet they're also missed by other tax preparers. Because when you look at a 1099 interest statement for mortgage, you see on the top, and they all look different. That's one of the problems. Depending on the company that you get your mortgage from, they look slightly different. Some go this way and have a lot of detail. Some are small like this, and everything's on the front. Some have information on the front, down on the bottom, and the taxes are on the back. And some are right here, and the taxes are on the bottom. Depends on the company. Well, PMI, or private mortgage insurance, on most of them is right underneath your interest. But on some of them, it's on the back. So if that's the only thing that's on the back and you don't flip it over, you don't get it. Now, if you're doing your own taxes, you should be looking for it. But if you don't do your own, that's missed. So PMI right now has not been extended. It actually said it wasn't extended in 2015, but it was. Okay, it has not been extended in 2016. I would be shocked if that wasn't. I don't know where the home forgiveness one is for the indebtedness, but I would be really surprised if this wasn't continued. But that one applies to contracts, and basically, if you don't know what PMI is when you cannot put down 80% of the down of your mortgage. So when you're borrowing $100,000, you need to put down $80,000. I'm sorry, I did that backwards. If you're buying a house and it's $100,000, you need to put down 20%. You need to put down $20,000. So the mortgage is going to be $80,000. If you can't put down 20%, $20,000, let's say you can only put down 10, then you're going to take out private mortgage insurance for that additional $10,000. So you will pay an additional premium on that $10,000. Once you have paid enough of your mortgage to get enough equity to cover that 10,000, then you no longer pay that private mortgage insurance. So that was basically in there to make bankers feel more confident that you were not going to, if you defaulted on your loan, they'd get their money back. And the reason it's 80% is usually when you buy a house, you feel confident you can turn around and sell it for at least 80% of what you just bought it for. So it is phased out. It's phased out between $100,000 and $110,000. So the more money you make means you cannot deduct it. Philosophy there is the more money you make, you should be able to put 80% down on a house. And then like it's phased out for $50,000 to $55,000 if you're single or filing separately. Now points. We have not seen a lot of this lately because how have our interest rates been? Really, really low. And points are paid to lower your interest rates. So when interest rates are at a record low, you're usually not going to pay extra money to make them lower. You can. I guess that would make them even extra lower. But 1% of the principal amount. So if you're buying a $100,000 home, then you're pretty much going to, if your principal amount's $100,000, you're going to be paying $1,000 per point. So if interest rates already are at 3.5%, and you want to buy a point usually reduces it, the interest rate, and it just depends. Sometimes a point's going to reduce it a half a point, when I say point, and it's not necessarily 1 for 1. A point doesn't reduce it 1%. So that I can't give the details on because I'm not a mortgage person, but I don't remember that it reduced it. 1 point was 1%. 1 point I think was like a 0.5%. I don't think it was that drastic because that wouldn't be that bad. $1,000 to go a whole point, that would be a great deal. So I think it was like a 1/4 point or a 0.5 point. We actually paid this on our very first mortgage. We paid a point to lower it. But at the time we got our first mortgage, I think interest rates were at 8%. And it really wasn't that long ago. I mean, interest rates just really, well, I guess I have a 16-year-old. But still, that's, I mean, to me that's not long ago to go to 8 down to 3. And they've been at 3 for a long, 3 to 4 to 5, for a long time. Where are they going to go? I don't know. My brother just asked me. He said, I'm going to refinance. Should I do like another balloon or should I just lock in at this rate? And I'm like, you are asking the wrong person because I take no risks. I would be like, lock in at, he could get, I think he said 3.5. I said, I'd lock in at 3.5. I said, why would you want to take the risk of rates going up? And I would say that regardless of whichever president won. It has nothing to do with Trump or Hillary. With a new president, why would you take the chance? Something's going to happen. I don't know if it's going to be interest rates or something else, but something's going to go wacko. Whether good or bad wacko, something's going to go, okay? You have a new president. So why would you take the chance right now when you can get 3.5? If interest rates were at 8 or 7, I'd be like, balloon it, The highest I think I've seen them that I've been alive, because I remember my parents doing it, was like a 10. So if you're at 8, take the balloon. Go low and lock in later. But they're at 3.5. It's still just low. So I think he locked in. I don't know what he decided to do, but I think he locked in. So that's what points are. Now, points are not tax deductible necessarily if they're paid for a service. But if you're paying for them to lower your your interest rate, if they're on your primary mortgage paid at the first time you take it out, you can deduct them all at the time, right then. So if you pay $1,000, it's tax deductible. If you do it to refinance, then you have to spread it over the life of the loan. Points go on line 12 on the Schedule A. So far we have done line 10, 12, and 13. We skipped over 11, but 11 is mortgage interest not reported to you. And I know that might be shocking, but you could actually have interest you pay that was not reported to you. Some people actually pay mortgage to an individual that doesn't report it on 1098. So you can still deduct it. All right, so that was the one, refinancing a home. So, for example here, assume that Tyler and Jasmine bought a $300,000 home, financed over 30 years. They paid 2 points to deduct it, to get interest rates lower. They don't say how much. How much of the points can they deduct in the current year? So if it's 2 points to get the interest rates lower, how much of the points can they deduct in this year? What did we say a point was worth? 1%. So they paid $6,000. Now, how much of the points could they deduct in the current year if they paid 2 points to refinance? What did we say was the difference?
Well, they have to spread it out over the life of the loan, right?
And how long's the loan?
30 years.
30 years. So 6,000 divided by
So you're only doing $200.
six, right. There we go. 6,000 divided by 30. So that's really the only difference. All right, so you got a $300,000 loan. You got 2 points, 1% each year, or for each point, and then the difference there is they have to deduct, spread it over the life of the loan, which is 30 years. All right, so what else do we get to do if we own a home? We get to deduct property taxes. Property taxes go on line, they go upward now, we're going upward, 6, all right? Usually, I say usually, if you own a home, you have to pay property taxes. We usually pay them through something that's called escrow. You don't have to, but you pay them into an account with your mortgage. I do have a few friends that don't do that. They like to keep their own taxes and pay them at the end of the year. You can do that. Also, if you have your home paid for already, then there is no escrow. You just have you get a real estate bill at the end of the year, and you have to pay it. If you don't pay your real estate taxes, you can get your house a lien, and then your lien turns into we're going to sell your house. And they don't necessarily tell you. Like, they just assume that you know that you haven't paid your taxes. And it comes to a point where if you don't pay them, it can go up for sale. And you find out usually about a month before it goes up for sale that your house is going on for the short sale. They're going to sell it. So you definitely don't want to not pay your real estate taxes. You get a deduction when they're actually paid. So if you pay your real estate taxes in January 2017 for 2016, you get a tax deduction in 2017. If you don't pay your taxes in 13, 14, or 15, and you pay them all in 16, you get a really big tax deduction in 2016. So I wouldn't do that on purpose, but that's how it would work out. And then when it's sold, the buyer and the seller together get to deduct the taxes. So take a look at this real quick. So they bought a new house. The total property tax bill is $7,000, and they pay the full amount. And then it says that the property taxes are on a calendar year. What amount of those property taxes will the Jeffersons deduct? So they paid the full amount. But when did they buy the house? In September. So what amount should they be deducting? Do they get to deduct them all? They paid them. Exactly. Deduct the amount for the time they were in the house, which would be 3 months. So let me show you something here, in case you've never done this. This is in your book. It's in chapter 14, but it's the appendix of chapter 14. And so this is what a settlement statement looks like. And I'm going to blow it up just a little bit. Where's my autofocus? There we go. And it might be a little hard to see. Over here on the left is the sales price, any settlement charges, deposits and escrow. And then down here on line 211 is county taxes. So, you can't see my finger hand. Oops. I think I'm just too low. Hang on. There we go. Down here is county taxes, and it's $1,000. In this whole column that my hand is on, it's a summary of the borrower's transactions. So the borrower is going to pay $1,000 in taxes. Then in this column over here, the seller's transaction, there's the sales price, settlement charges paid to the seller, and then adjustments for items unpaid by the seller, $1,000. And then they have the cash down at the bottom of how much cash goes to each one. If you go to page 2, it actually details it out even more. And it goes through, for the buyer and the seller, all the different fees that they pay. Some of these fees could be tax deductible. But the thing you want to get down, here's private mortgage insurance. There isn't any. Here's interest from January 31st to December 10th, 411. Now, as long as you didn't switch brokers, you should have that interest. It shouldn't be a big deal. Your mortgage lender stays the same. And then if you come on down, here's your property taxes. You put in $11,000, and this was with the Jeffersons. Okay, you put in $11,000. When the Jeffersons buying or selling? They were buying. All right, so they put in $11,000. The only amount that they need to worry about is they're the ones, in this case, they bought it in a different month than we just showed on the other one. But they put in $11,000 for taxes. The seller had to pay them $1,000. So right from this, you can tell that what they should be deducting is going to be $11,000. If you're the seller, you could go back to your agreement and be like, okay, how much did I pay them? I paid them $1,000. Because sometimes the seller is not going to get anything telling him how much he paid in real estate taxes. That's one of the disadvantages. When you sell a house, at the end of the year, you're not going to get an interest statement that has taxes on it because you didn't pay them. You paid them to a mortgage company. So the only thing that you have to pull how much you paid in taxes is you need to go back to your closing documents and find out how much you paid in taxes, because you didn't pay them to the county, you paid them to the Jeffersons. But you still get to deduct them because you paid them. All right, hopefully most of that made sense. Hopefully most of that you've seen. Hopefully, for the most part, maybe outside of the indebtedness of the fact that it's $1 million and $100,000, most of that you guys have seen. It's just a matter of making sure you put it in the right places and you get to it. This is probably what you might not have seen as much about. So there's the 3 classifications like I've talked about. Here, instead of residence principal and then residence non-principal, we actually have residence with minimum rental use, which is 14 days or less, which to me means you're not really renting. And a perfect example of this, and you're going to see it in an example here in a second, is if you live around the Masters golf course and some of the other big golf courses, there are people that rent their house out just for that golf tournament. That is the only time of year they rent their house. So you're talking 1 week, maybe 10 days, out of the entire year that they rent their house. And they will rent it out for tens of thousands of dollars depending on the size of the house. And actually, I know some people that when the All-Star game came to St. Louis, they rented out their house. That one scared me a little bit more because the clientele in baseball games versus the clientele of golf matches are a little bit different. But they did. They move out and they go and stay with family or friends, or they go stay at a hotel if they booked it soon enough. But most of them go stay with family, and they rent out their house. We knew someone from AAA, which is American Accounting Association, who just moved to Augusta. And her friends were saying, you've got to get moved in and rent your house out. And she goes, I am not unpacking that quickly. And they're like, you have to. And she did. She unpacked, and she rented out her house. And I think she said she got $5,000 for the week. And she just went and stayed with a friend. Slept on the couch for a week and made $5,000. Now, is she going to put it on here? I'm going to show you in a second. But residents with minimal is 14 days or less. That's her. It's not a rental. It's not a rental. She just happened to rent her house out for less than 14 days. So significant rental use is more than 15 days, and we're going to show that we actually lived there still. And then non-residence is basically all the other rentals that we have. So with minimal rental, we have to live in the home for at least 15 days and rent it out for 14 days or less. Notice there's a big gap in there. We can live in it for 20 days and rent it out for less than 14, and it can be empty the rest of the time. And it could be considered minimal rental use. Now, I don't know where that's advantageous to anybody, but it would still qualify under here. If you do that, you do not have to declare the rental income. So there's a big loophole in there for taxpayers that fit into that little category. That's $5,000 that she did not have to declare as rental income. No rental expenses except those that are personal itemized deductions, home, mortgage insurance, and rental real estate. So no deductions for the fact that she rented it, but her home mortgage insurance and all that still are just normal everyday expenses. Significant rental use are vacation homes typically, or condos down at the beach or the mountains or the lake. So you rent it for more than 15 days, you live in it for more than 15 days, or 10% of the fair market value days rented. This thing, you include your income in the gross income, and you allocate your expenses. And I'm going to show you how you do that. If you do that, you are usually looking at putting it on line 17 under rental income. And then with this, there are a couple different things we can do. So expenses allocated to personal use are not deductible. Expenses acquired to the tenants are deductible in full. So if the tenants come in and destroy something and you have to come in and repair it, it's fully deductible. Even though it might be to the stove. The stove is something that you're going to use too, but the tenants destroyed it, it's fully deductible. Expenses allocated to rental use deductible only to the extent of gross rental are deductible expenses to acquire tenants. And then expenses must be deducted in a specific order. So we'll talk about that. There's three categories. There's Tier 1, Tier 2, and depreciation. It says Tier 3, just call it depreciation. It's the only thing that's on it. So Tier 1, Tier 2, and depreciation. Tier 1 is all the expenses that are deductible without regard to anything else. So basically, can you deduct it even if you weren't renting? Yes, that's Tier 1. Tier 2 is all the expenses that regard to renting except depreciation. And you don't get to depreciate your house unless you rent or use it for business, right? So for renting and we're depreciating, that's Tier 3. So generally, expenses are allocated based on the number of days. There's two different ways to allocate those based on days. There's the tax court ways, and there's the Bolton method. I don't know why it's called the Bolton method. I'm sure it's after some guy. But so the tax court or the Bolton. So we'll look at this example first, and we're going to do it both ways. So Jefferson's purchased their home in vacation home in Scottsdale for $400,000. They put $100,000 down, and they financed the $300,000. 6%. During the year, they used the home for personal for 30 days, and they rented it out for 200 days. Now that's one of the key parts you have to use when you're doing rental expense, is how many days did you rent it, and how many days did you use it for personal. They had $37,500 of rental income and incurred $500 of rental advertising expense. How are their expenses allocated under both systems? So, looking at it on both. Now, I'm not going to make you guys do this right now, so we'll just look at it. So, advertising, interest, taxes are Tier 1. So that means they would have occurred regardless, with exception of one. So interest, that's our mortgage, right? Do we have mortgage whether we rent or not? Yes. Real estate taxes, do we have it whether we rent or not? Yes. Do we have advertising whether we rent or not? No, but will we have the expense whether we rent it or not? We can, if we advertise, even if no one rents, we're going to still have the expense. All right. So, Tier 1. Under the IRS method, you take the number of days you rented times the number of days it's used. So we rented it for 200 days, we used it for 30. So it's 200 days rented divided by 230 days. The IRS doesn't care about the other 135 days. We used it for a total of 230 days, 200 of which we rented. Notice advertising is fully deductible because it only has to do with renting, but it's tier 1 because it would have happened regardless, even though we didn't rent. The other ones, we multiply 18,000 times 200 over 230. Because the majority of our mortgage interest is regarding the rental. Because we rented for 200 days out of the 230 it was occupied. So even though we can deduct it on our Schedule A, the majority of it's going to go on a Schedule E. Our real estate tax is the same thing, 5,000 times 200 over 230. Then our other expenses, utilities, repairs, insurance, and maintenance, those are tier 2. And under the tax method, it doesn't matter. We're going to multiply those times 200 over 230 also. And then depreciation is tier 3. And we multiply that times 200 over 230, which gives us our depreciation. Now, what is different with the tax court method versus the IRS method? All right, tier 1 is 200 over 366. All the others are 200 over 230. So the tax court method is different from the IRS method in that the court method says these 3 things under tier 1 for you and I who live in our house happen 366 days out of the year. I don't know why. 366 days out of the year. So these should be spread over 366 because if we weren't renting our house, interest and real estate taxes would be over 366 days, 365 days. So that's why they should go. So we would take all of 500 again, and then we would take the interest, 18,000 times 200 over 366. So notice, a lot less goes to rental. More is going to go on my Schedule A. Same with real estate taxes. Less goes to rental, more goes to Schedule A. And then the rest of these numbers don't change because they go under the same formula. So the only difference between the IRS and the tax court method is that tier 1 goes over the number of days used for rental divided by 366.
Okay, then the taxpayer can choose between which one?
The taxpayer can choose between which one they're using right now. There might be some instances which are mandated, but yeah. Okay, so a non-residence, okay, that's when we're using, right, that's when we're renting it and we live in it. Now, for those that we don't live in, so those when we go down the street and it's just rental property, all right, you get to include all your income and you get to deduct all your expenses. So the friends of mine that have rental property that we include, some of them actually bought it to flip and couldn't flip, okay, kind of the worst type of rental property you wanted. All the income, all the expenses. So the property, if the property is used for even a day of personal use, the expenses must be allocated. So if you're renting an entire lake house, and then for some reason in 2016 you decided to live in it for 2 days, you now have to allocate your expenses between personal and rental. Now, I'm just curious, how many of you guys think that actually happens? Okay. Think of all the rental property down at the Lake of the Ozarks. Think of how many are probably 98% rental, but an owner stays in it, hit or miss. Now, I can't substantiate that, and I will tell you it's wrong, but I can tell you I think it happens. Now, could the owner be fixing it up? Yes. And if they're in there fixing repairs, that does not count as personal time. So if they're smart, when they're enjoying their rental lake house, they are repairing something, right? And then they're technically not breaking any laws. But, I mean, I do think there's a lot of rental property down there, but I do think a lot of the rental property is also personal use. I do think it's a combination of both, at least down at the Lake of the Ozarks. I think that there are, I think there's some just flat rentals, but I think they're owned by companies and not people. I think most of the people-owned ones are also personal-owned ones. I don't think there's a ton of people-owned that don't even go at all. It's just too close to everybody. I think there's some people-owned ones that are like down in Florida that people might not go to, but I don't think of the Ozarks. Tax, huh?
I said that's kind of like Innsbruck.
Yeah, exactly. People that own a house at Innsbruck and might rent it, they still go because it's right there, right? Taxpayers are not allowed to deduct the personal use portion of Tier 1 because property doesn't qualify as a residence, obviously. And personal use portion of Year 1 property taxes are deductible from AGI under itemized deductions, which is what we just went through. All right, so the Jeffersons did not use the home at all for personal use. They received $37,500 of gross income and incurred $4,439 of expenses related to the property. How much of those expenses can they deduct? Don't think too hard.
They should be able to deduct it all.
They can deduct it all. However, there's a typo on the next
They're
screen.
showing a loss.
Right. It should say 40,439. There's a typo. Yes, and they get a loss on the property. Now, before I change screens, can you deduct a loss on a Schedule E? Yes. For how much? All of it? Can you? Oh, see, I just made him roll his eyes.
25?
Up to $25,000. All right? Because it's rental property. Because on a Schedule E, yes, but on that line, it's also royalties, partnerships, escorts, trust, etc., right? All right. So losses are generally not allowed for passive activity losses unless you have passive activity gains, which was one of the chapters you guys did not like, right? But in that chapter, we talked about except rental activities. So passive activity losses usually, I just said that. So $25,000 is the exception. You must be an active participant in the rental activity in order to do that. However, there are income limitation, so that $25,000 is phased out for every 50 cents that you go above $100,000, and it is phased out completely once you hit over 150. And my wonderful friends that have that house that they went to flip, but they couldn't flip, and now they're renting, they've lost money on it. Well, I think the last 2 years they might have got money, but they lost so much on it the first several years that they keep rolling over the loss. They make too much money to get to deduct the loss. So even though they kept having losses after loss after loss, they were not able to deduct any of the losses. So not only did they buy it and lose money because they couldn't flip it, then they had no one living in it, and no one living in it, got someone to live in it, horrible tenant, caused all sorts of damage, had to kick them out, had to get a lawyer to get them evicted, had to repair the damage, got somebody else in, were not able to deduct any of the losses because they made more than $150,000. So, kind of got kicked. So, see, my not taking any risk when it comes to things pays off sometimes. All right, so the Jeffersons incurred a loss in their rental, and they didn't have any passive activity. Their current AGI is $120,000. They are considered active participants. How much of their rental loss could they deduct with regard to their rental real estate? $15,000? Okay. It could be $15,000 except
12,900.
except for it's $12,939. You can't deduct more than you had. But $15,000 is what they would be limited to, and their loss was only $12,939. So that's where they came up with it. So, but you want to make sure you know how to do that phase out amount when it comes to the passive activity losses. So with regards to your homework and with regards to the final, you want to make sure you understand how to come up with a couple things on the rental income, because I think that's actually the hardest part of this. You want to make sure you know how to do the IRS and the tax court. And usually the biggest confusion is you get mixed up when it comes to the IRS and tax court with, like we had rental days over total days. So it was 200 over 230, because it was the total days used, not 366, all right? And then the tax court was tier 1, was total days rented over 366, and then the rest was 200 over 230. So that was confused a lot on prior exams. And then when you do have a loss, what can you deduct? All right, and then the last part of this chapter talks about the home office deduction. Now, this used to be something that was extremely scary. When I first started, when I used to do a lot of taxes out of my home, it was one of those like taboo things. You did not deduct your home office. You just did not do it. Because at that time, you had to have a designated room in your home that was your office. It had to have walls. It had to be extremely, like this is it. And over time, that has become a lot looser due to the fact that there's so many people that work from home. And the definition of an office is no longer the definition of an office. I mean, an office is someone's couch, it's someone's kitchen table. It's not 3 walls and a door. So working from home, to qualify, you must work exclusively from home or regularly from home to deduct that time. So, for example, I work a ton from home. A ton from home. I'd probably say, honestly, I work as much from home as I do from here. But I don't deduct my home. That's not my home office. My home office is here. It's just such that between my life and my office hours here, I'm able to work a lot more from home. And that's a convenience for me. When I worked at Reuben Brown, while continuing to work here, I did not have an office at Reuben Brown. My office was my house. And I did complete 100% review and all my work from home unless I went to a client. Then I did deduct my house because I didn't have an office. That was it. So deducting your home is a much different thing. I have friends that sell AdvoCare. It's a energy type weight loss, blah, blah, blah. Okay? So that is a strictly from home because they're teachers, they're nurses, they're a whole bunch of other things. So that is something you do from home. So it's not a 4 walls, but it does have to be something where you are working. Your principal place of business is your house. All right? And that where you meet with clients or people, or you have to go meet at a Panera, or you have to go meet at their office. You don't have this. I don't have you here. Okay? So that's what you're looking at. Now, you deduct any. So it's an unreimbursed business expense typically. All right. So, and if self-employed, it's deducted for AGI. So there's 2 different places. So if I'm an employee of somebody like Reuben Brown, I was technically being paid as an employee, but I didn't have a job as an employee. That's why I was at home. So I put it under unreimbursed business expense because I was not a contractor. But if I would have been a contractor, then I would put it as for AGI, and it would have been a Schedule C, and it would have been under that. So my friends that use, that sell the AdvoCare, they're Schedule C. All right. My friends that do other type of things from home, Schedule C. But when I worked for Reuben Brown, but then just didn't have an office, or my friends that work for AT&T, but work from home, but 1 day a week, they're all, as an itemized deduction, home office, because they're employees of AT&T who just happen to work from home and deduct their home office. Now, there's 2 different ways to do it. There's the actual expense and the simplified method. Simplified method is new, all right? The actual method, you have to go in and say, this is how much it costs for me to have my expenses in the house, and this is how much I think I have. You can do direct and indirect. usually what you do is you say, the area I'm using is like 10 by 10. And my total expenses for the house, and you break it down by different, is this. And they'll take, okay, you're using 10% of your house. Here's your expenses. Direct versus indirect. And indirect is based on the square footage. Direct is saying, I use this much of my phone, this much paper, and this many stamps. Okay. The simplified version is new. And, wait a minute, did I just skip it? Okay, it's coming. We'll come back to simplified measure. Okay. What was I saying? The deduction is limited to gross income. You can't go above gross income. And depreciation, that's a big thing. Depreciation of the house is key. It does have to be recovered if you sell the house. And it's the same sequence as with the vacation home. It's tier 3. And it's probably the biggest reason people deduct their home on their taxes is the depreciation that they get from it. It's a big expense that shows up and helps them with the reduction of their taxable income.
So they're gonna get the 39 years or the 27.5?
It is 27.5.
Okay.
But you have to know the cost of the house, you have to know the price of the land.
But if it's considered, I think it's 39, so
Actually, you know, you just said that. Rental property is 27.5. The house is 39.
39.
Yeah. Now, the simplified method is going to take, it's limited to 300 square feet. Basically, you can't have a bigger space, which most people don't. Times $5 a square foot. Maximum is $1,500 that you can deduct. It's limited to a Schedule C, minus any business expenses. No depreciation. So it's a very simple way of doing it, but you're easy and you're done. You can choose either one. You don't have to use the same one from year to year. So you can start off simplified and then realize you need to get more complicated. Now, a lot of people, it didn't say this in here, a lot of people have not wanted to do this, not before because of why I told you, but still because by declaring a home office deduction, it does bring your return up to the light of auditors. They do not randomly select, they do not specifically select returns like they used to. But if you ever used anything, the more things you have that complicate a return, the higher chance you have of being audited. And having a home office deduction complicates your return. So it just raises you up a little bit. And a lot of people, if that's the only thing they have on the return, they don't want to do it. So they don't do it. My dad was a contractor the last few years, 8 years for the government, doing what he did before he retired. And I told him he could deduct it from home. That's the only place he did. And he goes, yeah, I'm not doing that. Not for what he was getting. And honestly, he wasn't going to get anything. He would have gotten an extra $25, $30. He goes, I'm not doing it. Not for that. I'm like, okay. So that's how a lot of people view it. Okay, so it's our last class of new material. So as I mentioned before with regards to your project, please don't wait until last minute. I know most of you guys have done something, please don't wait. You can upload it as many times as you want. I wouldn't get too crazy because you're going to drive yourself crazy. If you're just constantly uploading, you're just going to drive yourself nuts. You're laughing. Are you doing that already? Okay, once isn't.
I plan to do more.
Once is not bad. But, I think it's good after you work on it for a while to upload it and to see how you're doing. But it's kind of like hitting check my work. If you hit check my work after every step of a problem, you're causing yourself to go slower because it takes you a while to go back in and upload it, see what you did wrong, and then start over again. Work on a whole section, or do a whole step. If you haven't started yet, I suggest you go through, and like when we worked after class last week, she had things checked off. And you had gone through and looked at everything. She printed it, which remember was my big suggestion, print your instructions. Everybody's are slightly different because your numbers are different. She had gone through and she had looked at everything, and you had entered, I assume, some of it, and then she had questions on some of it. Go through and enter, get the names typed in, get the kids typed in, get your income if you know the income's out, get stuff typed in that you know how to do. Get the, itemized deductions might change, but maybe dividends aren't going to change, and interest. So get that stuff done. And then go back and look at what you have questions on. And then if you still have questions, maybe upload it. and say, okay, I still don't know how to answer these 5 questions, but let's see how I did on the ones I thought I knew how to do. And then go from there. Just don't wait until Thursday night, because I won't be on my computer for people screaming at me, okay? As for your exam, let's see if I got my mouse back. Probably not. Your exam, so I will be here next Tuesday. You do not have to come. I will be here, okay? Because there's no new material. Your project is due Friday, but there's technically nothing. I will be here. More than likely, I still don't have a mouse. How is that possible? Okay, who has a syllabus? You do? Okay, what's it say?
For the final exam, it says online from the 11th through the 15th.
Okay. So, it's online from the 11th through the 15th, which is
So Sunday through something.
Sunday through 11, 12, 13, Sunday through Thursday, all right? So, it's 11:59 on Thursday night. Make sure you're done by then. So, your project is due Friday. Your exam opens on Sunday through Thursday night. So, finish one, start the other. This homework is open, obviously, for the normal week that it is. So, I'd honestly get this done, out of the way, and then work on the project. The